Hey everyone, welcome back to the Deep Dive. Whenever we talk about building wealth, there's this big question that always comes up. It's long-term versus short-term investing. And it's not just about the money itself, it's really about what kind of life you want. What kind of future are you aiming for?
Yeah, for sure. It's a fundamental choice. And for today's session, we've actually pulled together a ton of great resources on this exact topic. We're going to take a real deep dive into the core ideas behind these two basic approaches to investing. The goal, really, is to help you get a good grasp on what each one involves and how they can play out over time. But even more importantly, we want to highlight what the differences actually mean for you for your own personal journey.
Absolutely. So before we get into all the details, let's quickly set the stage. When we say long-term investing, we're usually talking about holding on to investments, things like stocks, bonds, maybe real estate for more than a year. The whole idea is to let those assets grow over time, sort of riding out the ups and downs that are bound to happen along the way. Think of someone like Warren Buffett, right? He's pretty much the poster child for this kind of patient, long-term approach.
Right. And on the flip side, we have short-term investing, which is all about holding those assets for less than a year. It's more about aiming for faster profits. But with that comes more risk, right? Someone like George Soros, who's known for being a bit more of an active trader, taking advantage of shorter-term trends, that's more on the short-term side of the spectrum.
Exactly. And at the end of the day, we want you to walk away from this feeling empowered. We want you to really understand how these strategies work and which one, or maybe even a combination, lines up best with your own financial dreams, with the kind of life you're trying to build.
Exactly. And it's interesting. This topic is something that really should be top of mind for everyone, but especially for those who are just getting started with their financial lives. Our research really hammers this point home. Grasping these fundamental ideas about investing, they say it's absolutely essential for anyone who wants to build real, lasting wealth. And that's especially true for younger folks, right? Because the decisions they make now, well, those choices have a lot more time to have an impact.
That's a really great point. It's like the younger you are, the longer your runway, so the more potential there is for your investments to really take off.
Yeah. A good way to think about it might be like gardening. Think about planting a tree. If you go with a short-term approach, it'd be like trying to grow some quick veggies, which can be great. But if you plant a tree, well, that takes time, right? You're in it for the long haul, but it's going to give you fruit for years and years to come. Even when there are seasons where it doesn't seem to be growing much, it's still working beneath the surface. And that long-term perspective really allows for something really powerful to happen. That's compound growth.
Compound growth. That's a term we hear a lot, but can you kind of break it down for us? Why is it so important, especially for long-term investors?
Totally.
Yeah.
Let's say you put $100 into an investment, and let's say it grows by 7% in the first year. So now you've got $107. But here's the thing. In that second year, you're not just getting 7% on that original 100, you're getting 7% on the 107. You're earning interest on the interest. So you get another like $7.49, bumping you up to $114.49. Now that might not sound like a huge deal at first, but over decades, this snowball effect really kicks in. The longer your money's in the game, the more that interest on interest just keeps building and building. That's the power of time and compounding that a lot of those quick turnaround short-term strategies, they just don't quite capture that same magic.
Ah, okay, yeah. Now, that really paints a clear picture of why long-term can be so appealing. So when we talk about what actually goes into a long-term investment strategy, our sources point to things like stocks, bonds, real estate. What's the logic there? What makes these good fits for the long haul?
Well, historically, these types of assets have shown a pattern of going up in value over longer stretches of time. And in a way, they kind of mirror the growth of the economy as a whole. Of course, there are always going to be short-term swings, right? The market goes up, it goes down, it's just volatility. But the general trend over time, it's typically been upward. So if you're in it for the long game, you're basically positioning yourself to ride that wave of general economic progress, letting time smooth out those inevitable dips along the way.
I see. Okay. And then on the other side, you've got short-term investing, which, as we mentioned earlier, often involves things like options, futures, forex trading. Those sound a bit more, I don't know, complicated. Can you give us a quick rundown of what those actually are?
Yeah, they are definitely different beasts. You see, short-term investing often uses things called options. An option, it's kind of like having a reservation. It gives you the right, but not the obligation, to buy or sell something, an asset like a stock, at a certain price, but only within a specific time frame. So it's a bet on whether the price will go up or down. And then there are futures. These are basically contracts to buy or sell something. It can be anything from oil to gold at a specific price on a specific date in the future. So you're kind of locking in a price today, hoping that the price will move in your favor by that future date. And then there's Forex trading, which is all about speculating on the changes in value between different currencies, like the dollar and the euro, for example. The big thing with all of these is that their prices can jump around really quickly. Like they react super fast to any news or any little change in how the market's feeling.
So the trade-off here is that the potential for those quicker returns comes with a lot more risk, right?
Exactly. Our sources are pretty clear about that. They say, hey, listen, if you want the possibility of making faster gains, you got to be ready to handle potentially bigger losses too. It's just the nature of the beast. These short-term markets are very sensitive, like a hair trigger almost. Prices can swing wildly, even from seemingly small events. To do well in that kind of environment, you really got to have a deep understanding of how the markets work. It often takes specialized knowledge and a lot of dedicated time to constantly monitor trends, react to news, and make those split-second decisions. It's not a passive game, that's for sure.
Gotcha. Okay, so let's shift gears a bit. Let's talk about some advice that's really tailored to you, the listener, the person who's trying to figure all this out. Our sources actually lay out some really clear steps to take. The first one they emphasize is defining your financial goals. I mean, that might sound basic, but why is it so crucial for deciding between long-term and short-term investing? Why does it even matter? It matters a lot because really it's the foundation of your whole investment strategy. You have to ask yourself, what am I actually trying to do with my money? Like, are you saving up for retirement, which could be decades away? Or maybe you've got your eye on buying a house in, say, 5 years. Or are you more focused on shorter term gains, like for a down payment on a car next year? Your goals, they really dictate the timeline you're working with. And that timeline, well, that heavily influences the types of investments that make the most sense. For those longer term goals, you're usually better off with, you guessed it, long term investments. They have more time to ride out those market waves and reach their full potential.
Okay, that makes a lot of sense. So the next thing our sources talk about is assessing your risk tolerance. Basically, figuring out how comfortable you are with the idea of losing money. How do you even figure that out? And how does that play into choosing between long-term and short-term? That's a big one. And it's all about being honest with yourself. It's about taking a hard look in the mirror and saying, okay, if my investment suddenly dropped in value tomorrow, how would I react? Like, would I freak out and sell everything, maybe locking in those losses? Or would I be able to stay calm and ride it out, knowing that the market has its ups and downs? How you emotionally respond to those market swings, well, that tells you a lot about your risk tolerance. And our sources highlight that while long-term investing tends to be less risky over the long haul, those short-term investments, they can be a real roller coaster ride in the short term. So if you're the type of person who would lose sleep over every little dip, it might be a good idea to lean more towards that long-term, steadier approach. It'll probably be a lot better for your peace of mind in the long run. It's really all about avoiding those rash decisions driven by fear. That's a big key to success in investing, not letting your emotions get the best of you.
Yeah, for sure. Okay, point number 3 from our sources. Educate yourself continuously. So it's not just a one and done thing.
Not at all. It's like a never-ending journey, and for good reason. The financial world is always changing. New trends pop up. The economy shifts gears. New investment tools and options come along. So, staying informed, it's an ongoing process. You got to keep up with what's happening in the markets, pay attention to economic news, and constantly learn about different investment options. Our research even mentions a book, The Intelligent Investor, by Benjamin Graham, as a great resource for understanding those core investment principles that have stood the test of time.
Ah, yeah, a classic. So by continuously learning, you're essentially giving yourself the power to make smarter decisions and adjust your strategy as needed, really.
Exactly. You stay flexible, you stay adaptable, you're not caught off guard when things inevitably change.
All right, the next piece of advice is one we've all heard before. Diversify your portfolio. But how does that play into this whole long-term versus short-term thing? What does diversification actually mean in this context?
Diversification is all about building a safety net, right? Like the saying goes, don't put all your eggs in one basket. So instead of putting all your money into just one type of investment, you spread it out across different asset classes. Like for your long-term portfolio, maybe you have a mix of stocks and bonds. That way, if one area isn't doing so hot, it doesn't take down your whole portfolio. Some folks even say that a little bit of short-term trading can be a part of a broader diversified strategy. But again, got to be super aware of those risks and make sure it fits with your overall goals and how much risk you can stomach.
Okay. Yeah, that makes sense. Spreading things out, not putting all your eggs in one basket, that just makes sense. And finally, this last one, I feel like it's especially relevant for those who have time on their side. Start early and be consistent. What's the magic behind those two things?
It's a powerful combo, for sure. Starting early, that's how you really give that compounding magic we talked about earlier a chance to work its wonders.
Mhm.
The more years your money is invested, the bigger that snowball effect gets. And then there's consistency. It's about taking the emotion out of investing. By investing regularly, whether the market's soaring or taking a dip, you're doing something called dollar cost averaging.
Yeah.
Basically, buying more shares when prices are low and fewer when they're high. It's a way to kind of smooth out your returns over time. It keeps you from trying to perfectly time the market, which, let's be honest, is super hard to do even for the pros.
Yeah, trying to time the market, that's a fool's game for sure. Okay, those are some really solid steps for our listeners to consider. Now, I noticed that some of our sources also touched on some more, let's say, outside the box ideas. Like for those who are maybe looking for something a little different, a little less conventional, what are some of those options?
Yeah, they briefly mentioned looking into alternative investments, things like art, collectibles, maybe even cryptocurrencies. Now, these can potentially offer some diversification benefits, and in some cases, they might even have the potential for really high returns. But, and this is a big but, they often come with a lot more risk, and they might not be as easy to buy or sell as those more traditional investments like stocks and bonds. So before jumping into those waters, you really got to do your homework, understand the risks involved, and proceed with caution.
For sure. Always got to do your due diligence. And another area they touched on was sustainable investing. This seems to be gaining a lot of traction lately. What can you tell us about that?
Sustainable investing, sometimes called ESG investing, it's all about thinking about more than just the money when you're making investment decisions. It's about considering the impact on the environment, on society, and on how companies are governed. So you might choose to invest in companies with really strong environmental track records, good labor practices, ethical leadership, that sort of thing. And it's not just about feeling good, although that's definitely part of it. Some studies even suggest that these companies, the ones with strong ESG practices, they might actually be more resilient over time. They could even offer better returns in the long run. It's an interesting area for sure.
Yeah, definitely something to keep an eye on. Now, to kind of bring all this to life, let's circle back to some real world examples. We've talked about Warren Buffett as the ultimate long term investor. What are some of those key principles that have guided his incredible success?
Buffett's approach really comes down to something called value investing. It's about finding those companies that are fundamentally solid, companies that he believes are actually undervalued by the market. Then he holds on to those investments for a long, long time. He's not phased by short-term market swings. He's in it for the long game. Patience and a deep understanding of the businesses he invests in, those are his hallmarks. He always says, buy good companies at a fair price and then let time work its magic.
And, the contrast with someone like George Soros, who's more about those short term plays, that really highlights just how different these approaches can be, right?
Yeah, it really does. You see, Soros, he made his name by figuring out big macroeconomic trends, seeing those shifts in the market that happen over shorter periods, and then capitalizing on them. His strategy is often about making big bets based on his analysis of what's going on in the world, in the economy, and in politics. It's a whole different ballgame compared to Buffett's value investing style. It takes a much higher appetite for risk, a constant finger on the pulse of global markets, a willingness to make bold moves. It just goes to show there's no one right way to invest. It all depends on what you want to achieve and how much risk you're willing to take on.
I see, I see. Hey, by the way, our research also unearthed a couple of pretty interesting facts. Did you know that the longest bull market in history, it actually lasted for over a decade?
Yeah, that's a pretty impressive run. It really underscores the potential for wealth creation during those extended periods when the economy's humming along. It's a good reminder that while markets definitely have their down cycles, they can also have these amazing stretches of growth. And for those who stay invested for the long haul, they can really reap the rewards.
Absolutely. Oh, and this one's kind of fun. The term bear market. When the market's going down, well, it comes from the way a bear swipes its paw downwards.
Ah, I love that. I hadn't thought about it that way before, but it's such a vivid image. It definitely makes it easier to remember what a bear market actually is.
Right. Those little details, they make it all a bit more relatable. Okay, so as we start to wrap things up here, what's the big takeaway for our listeners when it comes to this whole long term versus short term investing debate?
Well, the most important thing to understand is that it's not about choosing one as being better than the other. It's about making choices that truly align with what you want to achieve financially, how much risk you're comfortable with, and what your current financial situation looks like. It's a personal thing. There's no one-size-fits-all answer.
I hear you. And maybe a really smart strategy involves a bit of both. Like maybe you allocate most of your money to long-term growth, aiming for that steady compounding magic. But then maybe you set aside a smaller portion for some shorter-term opportunities, knowing that those are higher risk, but could potentially bring in some quicker gains. It's about building a strong financial foundation that's tailored just for you.
Exactly. And understanding these basic approaches, that's the first crucial step.
Absolutely. So, as we come to the end of our deep dive into long term versus short term investing, remember this. This isn't just some theoretical stuff. This is about building a solid, secure, and prosperous financial future for yourself.
And with that in mind, I want you to consider this. Think about where you are in life right now. Maybe you're just starting out your career, full of energy. Or maybe you're closer to retirement, looking back on all you've achieved. How does your current life stage and where you want to be in the future, how does that influence the ideal balance between long-term and short-term strategies for your unique situation? What are some concrete steps you can take starting today to really get clear on your financial goals and figure out what your comfort level is with risk? It's all about taking what we've discussed today and applying it thoughtfully to your own individual path.